Yeah, that urgency really comes through. And, the report makes a strong case right out of the gate by setting up this dichotomy between a super low market price and this big Bitcoin asset base.
It's a powerful hook. You see a $73 million market cap, and then you see nearly 5,900 Bitcoin, and you immediately get it. And this is the first big thing for me, the analysis report really needs to integrate the story of that massive decline from $13 down to 90 cents into the fundamental argument. That's a great point. Because right now the core idea is there, buy a dollar for 50 cents. But the report kind of presents the technical drop and the fundamental undervaluation as two separate facts.
As two isolated things, yeah.
Exactly. It shows the discrepancy really well, but it doesn't really explain the why. What was the corporate event or the market event that caused this extreme re-rating in the first place?
And that leaves a huge gap for anyone reading it. The report has to answer why the market is pricing this thing so low right now.
Right.
Without that context, you're left wondering if the same destructive force that caused that initial collapse is still lurking in the background.
That's it, exactly. You can't just say, look, the price is low. You have to explain how it got low and, maybe more importantly, why that reason isn't valid anymore. The weakness is that the market overhang is. It's there on the chart, but it's not really addressed in the text.
Okay, but let me push back a little. Does spending too much time on the past, on that $13 high, risk watering down the urgency of the setup at 90 cents? I mean, the whole point is that it's an urgent call.
I get that hesitation. I do. But this kind of analysis is meant to build conviction for, a significant capital allocation. And that kind of real conviction only comes from fully understanding and resolving the past.
Okay.
So the suggestion is to frame this whole undervaluation thing not just as some vague fear discount. That's too generic. Frame it as a quantifiable recovery from a specific, identifiable event. That kind of reframing, it just boosts the conviction behind the whole bull thesis.
So you're turning it from just a technical observation into a full strategic narrative.
Precisely.
I like that. So let's make it concrete. What are some examples of how to do that? I suppose one way is to just clearly identify the nature of that $13 high. Was it pure speculation on an old business model that failed, or just a weird liquidity spike?
Yes, you have to define that ceiling to understand the current gravity. And building on that, you have to specifically reference the date of the corporate pivot to a Bitcoin treasury model. That event is the real line in the sand historically.
The moment the old ASSAs became the new ASSAs.
You got it. You have to draw that line historically just as clearly as you draw the technical one at 88 cents.
So for instance, you could actually write something like, the current 90-cent valuation reflects the psychological overhang from, specific past event. But that risk is now fully priced in because the 5,900 BTC anchor acts as an objective floor.
That level of detail is what adds analytical depth. It shows you haven't just stumbled on a cheap stock. You understand why it got cheap and why the original problem, whatever it was, is basically neutralized now by that Bitcoin on the balance sheet.
Okay, that really tightens up the whole argument. So that covers the need for context. Let's move to the second big point, which is about integrating some constructive skepticism, especially given how urgent the report's tone is.
Yeah, the all caps don't sell. To really increase the authority of the report, a dedicated section has to address the potential counterarguments to the core thesis. You just can't present a thesis this aggressive without showing you've managed the downside.
Right. The weakness here is that the tone is just so bullish, buy of a lifetime. And, ironically, that almost makes it less credible as a serious analysis.
It can, yeah.
It identifies 88 cents as the line in the sand, but then provides, zero analysis for what happens if that line is breached. If that floor breaks, the report just loses all its authority instantly. There's no plan B.
That is the core issue. Is there a risk that focusing only on this gap fill, that it overlooks the possibility that this is actually a liquidity trap, not a spring-loaded opportunity? That's the question a smart investor is going to ask.
And the report needs to answer it before they even think to ask it.
Exactly. The suggestion is to bring in some conditional analysis, some risk mitigation, neutralize the main bear case before it even has a chance to form in the reader's mind.
So we're turning that urgent bullishness into a more calculated conviction. By actually acknowledging and modeling the downside, the bullish case becomes stronger, more resilient. So how do we talk about an 88-cent break without causing panic?
Well, you need concrete, quantitative indicators that would invalidate the theory. So instead of just saying, if it breaks, we're wrong, you define what a real break looks like. What level of volume on a breach of 88 cents would suggest it's something more than just a stop-loss cascade?
That's a great distinction. Are we talking about retail panic, or is it like institutional selling?
Exactly. For example, the report could define the exit criteria. Say a close below 85 cents on 5 times the average daily volume would be a sign of real structural weakness. That prompts an exit.
Okay, so you're quantifying the exit. That makes the entry feel a lot safer because you have a pre-agreed rule for when to admit you're wrong.
And since the whole thesis hangs on the Bitcoin treasury, you have to address the main external risk. Suggest analyzing what happens if Bitcoin prices just stagnate or even drop. That would remove the fundamental catalyst for the whole thing.
Absolutely. If BTC drops 30%, that whole fundamental floor calculation is completely different.
Which means you need to discuss the company's operational cash burn, if there is any. The reader has to know how long the company can survive on its treasury if the market or Bitcoin doesn't cooperate. A high burn rate just erodes that floor over time.
Even if the burn is zero, just analyzing it proves you've looked at both sides of the ledger. It's a sign of a sophisticated, balanced analysis. It shows you've thought a few moves ahead.
Right. And adding that layer of skepticism transforms the report from just shouting buy into a piece of calculated conviction.
Okay, that's fascinating. Let's pivot to the final critique then, which is about the transition from the analysis to the actual execution, what the report calls the conclusion and strategy.
The strategy section has to match the sophistication of the analysis. It needs to go beyond just, watching the 90-cent level and provide a detailed, staged plan that actually fits the extreme volatility of this asset.
Right. As it is now, the game plan seems to focus only on that initial psychological trigger of getting back over $1. And the weakness there is that for an asset that could move 300%, that's just way too simple. It doesn't tell you how to actually deploy capital around the key hurdles at 110, 150, or 360.
It's an all-or-nothing approach, and that just doesn't work in high-volatility situations. The suggestion is to advise a layered allocation. Base it on volume confirmation at those key resistance points, not just on a single trigger.
So you turn those resistance points into strategic decision points, not just lines on a chart.
Yes, and what that looks like practically is a strategy that incorporates scaling. For example, you could suggest a small initial pilot entry at, say, 95 cents if volume confirms the bounce. But, and this is critical, you reserve the bulk of the allocation for a confirmed break and hold above that first major resistance at $1.10.
The psychological benefit of that is huge. You get to capture some of the initial move without committing serious capital until the asset proves it can clear its first big hurdle.
And then you have to talk about exits. Suggest using those big price targets, 150 and 360, not just as final goals, but as points to take some partial profits, or to set trailing stops. It gives the strategy so much more depth than just hold until the target.
It makes the strategy dynamic, not static. So instead of one goalpost, you have a series of conditional staging grounds for action.
The analysis of AST's volume with moves in Bitcoin's price. I mean, since the whole argument is based on the Bitcoin treasury, you should be watching for moments where AST volume confirms a big BTC move, or maybe even lags it.
So if Bitcoin jumps 5%, but AST barely moves on thin volume, that suggests the market hasn't priced in what that move means for the treasury value yet.
And that delay is the opportunity you're trying to exploit. That's the nexus between the technicals and the fundamentals. Integrating that final check makes the whole strategy incredibly robust. It goes from just hope to a calculated, multi-layered execution plan.
This has been a really great breakdown. So to recap our critique, the analysis report is already strong on its technical levels and that fundamental discrepancy. But it needs to enhance its impact by 1. Fully contextualizing the extreme price drop, 2. Integrating some constructive skepticism and risk analysis, and 3. Providing a much more sophisticated staged trading strategy.
And to summarize the actionable suggestions, first, contextualize that $13 to 90 cent collapse by defining the pivot to the Bitcoin treasury model. Establish that old versus new ASST. Second, model the risks. Define quantitative, volume-based exit criteria if that critical 88-cent support fails. And finally, develop a staged allocation strategy that uses those key resistance points, 110, 150, 360, as conditional points for deploying capital and taking profits.
Excellent summary. Making these refinements will absolutely turn this urgent call to action into a much more authoritative and robust piece of financial analysis. We'd encourage you to make these changes and submit the improved report back to us for another look. Thank you for sharing your work.